Imagine that 10 years ago you retired with £100,000 in a pension pot that you wanted to take income from. The pot stayed invested to rise and fall with markets while you took regular amounts in income to pay you a living. How much would you have left? That is a question that is relevant to many more people thanks to a change made in 2015, which allowed more of us to fund our retirement this way. It potentially added much more flexibility to retirees, but also exposed more of them and their retirement income to the ups and downs of markets. So, how have they done? To answer that, I'm joined by Tom Stevenson, Investment Director here at Fidelity. Tom, welcome along. We're going to reveal the results of some analysis that we've done to put some broad numbers on this question, and we're going to get to those results in a bit. They are interesting, I think. But let's start with those changes in 2015. The 10th anniversary of those changes is coming up. What happened in 2015?
Yeah, so this is all down to George Osborne, who was the Chancellor at the time in that far and distant life before Brexit. David Cameron was Prime Minister, of course. So what he did was he introduced what we call the pension freedoms. And, as the name suggests, it freed people up to access their pension pots in a much more flexible way than they'd ever had the opportunity before. So if you roll back to 10 years ago, anyone with what's called a defined contribution pension, not a final salary pension, but a pension that you paid money into,
a retirement fund, basically, that you're going to use to
either through a company or through a personal pension, a defined contribution pension, you were obliged at the time to translate your pot of money into an income for life in the form of an annuity.
Yep.
And at the time, annuity rates were very low because they're determined in large part by the level of interest rates, and interest rates were practically zero at the time. So it was a pretty unsatisfactory arrangement for most retirees. And Osborne saw that and essentially gave people the freedom to access their pots in a variety of different ways, ranging from sticking with buying an annuity all the way to just taking the money out and spending it.
Yeah, and there was lots of talk at the time of, government ministers being very relaxed if people used all their pension money to buy a Lamborghini. That was the kind of classic example.
Yeah. Which, of course, no one did.
And it was a very, very significant change. It felt significant at the time. I remember it very well. I was covering it as a journalist. But I think arguably it's become more significant, or we've realised the significance of it more and more as the years have gone by. We're going to get to some of the reasons why. But just staying in 2015, the situation then, you mentioned the annuity market. Lots of people would have to go out and get an annuity. That's the product that you give all your savings or a chunk of your savings away to typically an insurance company or some company providing annuities. They give you this guaranteed income in return, potentially for the rest of your life. A great secure income, but as you say, the returns on annuities weren't very good in 2015. That's because interest rates were quite low, and annuities are priced in part based on gilt yields. They were low, so the returns on annuities were low. But also, the market wasn't working very well, was it? The market for annuities, because everyone was essentially forced to buy one, and because many people weren't particularly au fait with their options at retirement, they tended just to get to that point when they retired and then just rolled on to whatever annuity option was handed to them by their pension provider. And guess what? That wasn't always the best rate. There wasn't much competition. There wasn't much shopping around. And so George Osborne tore it all up, basically, and gave us pension freedoms. Now, the great sort of attraction of this was that instead of giving all your money away to buy an annuity, you got to hang on to that money. You invested it, and it would go up and down. I said this in my introduction, but it belonged to you still, right? And so that was a great attraction, but it has shifted risk onto individuals.
Yeah, that's right. So, I mean, there are, some attractions to an annuity, because in a way they kind of mimic the final salary pension, the old style pension, which just basically paid you an income for the rest of your life. Effectively continued replaced the salary that you stopped receiving when you stopped work and replaced it with a regular income. And an annuity does that, but the price that you pay for that is a complete lack of control. You hand over your money; it's no longer yours.
Yep.
You buy the annuity, you give the money to the insurance company, and that's it then. So. Yeah, I mean, it wasn't very attractive for a lot of people to have to do that, and now with the changes, you get to hold on to the money. You do have control over that money for the rest of your life, and the downside, of course, of that is that you are responsible um, for how successful your investments are,
Yeah.
and this is the great challenge for people. This is the difference between my generation and say my parents' generation, is that they don't really think about money in the same way because
No.
they just get a regular income from the government. My generation and subsequent generations will spend a lot of time worrying about, as we are at the moment. I mean, we're talking in the middle of a fairly sort of substantial wobble in stock markets.
Yeah.
That becomes terribly important when the comfort or otherwise of your retirement is determined by what happens in the markets.
Yeah. Well, and this is the point of the work that we've done, because back in 2015, the theory behind, sometimes called income drawdown, that's where you draw an income. Sometimes people describe it as taking lump sums from investments, two slightly different ways of taking income, essentially from a pot of investments. When people thought about it in 2015, it felt very sensible. Put it in the market, get the market returns, apply a sort of uniform level of withdrawals, and based on history, you're going to still end up with this pension pot that's still yours. It sounds great, but as you say, you've got to handle the ups and downs, and that's what this work really kind of gets into. So I'm going to sketch out, Tom, if you don't mind, the work that we've done. We wanted to answer the question, how did that very first cohort of people retiring under the new rules get on, basically? So we imagined someone with £100,000 of invested pension savings who retired on the very first day of the new rules on the 6th of April 2015. Our starting point was a pot invested in the stock market, 100% into global shares, but a geographical mix of global shares, with withdrawals set at 4% a year, for the very good reason that's a sort of long-standing, widely used principle for investment withdrawals. And the theory goes, if you withdraw that amount of money, you've got a very, very high chance of your money lasting for 30 years. In fact, you can take 4% and then increase that cash amount by inflation each year. So what's happened to that money? We also went on to look at what happened if you took 5%, 6%, and 7% withdrawals as well. And then finally, we repeated the entire exercise with a different portfolio, one of 60% equities and 40% bonds, the classic 60-40 portfolio. So the results. With withdrawals set at 4%, the pot, I was going to ask you to take a guess on, but I know you happen to know the answer, so I won't bother with that. With withdrawals set at 4%, the pot will have grown to £189,000 if invested in global shares. So, in other words, after an entire decade of taking income from that £100,000 pot, and now, of course, with 10 fewer years of retirement left to pay for, that pot is almost twice the size as it was at the start. Now, had you dialed withdrawals up to the maximum that we looked at 7%, you would still be left with £131,000. So, well, let's put a pin in it there. Were you surprised at all by those headline numbers?
Well, yeah, I mean, like you, I was surprised by the amount of money that was left at the end of the 10-year period.
Yeah,
you've taken an amount of money which financial advisors have typically thought would be a sensible amount that would not run down your money, but early.
Mm-hmm.
You would have money to last through retirement, but it was not designed to leave you with twice as much money at the end. So what that's telling us is that markets have been extremely kind over that period, and we sort of know that that's the case, but they haven't been consistently kind.
We've had COVID.
We've had
Russia,
Brexit.
Ukraine.
We've had
Indeed.
COVID. We've had Russian invasion of Ukraine. We've had lots of ups and downs.
Yeah.
So it's not an unrepresentative decade by any means. So yes, net, I was surprised by how much money an investor would have left.
Yeah, and I just wanted to flesh it out slightly. So unless it's not obvious, £100,000 invested, you take 4%, that's £4,000 of income in your first year. 5% is 5,000, etc., etc. So over the total period, with 4% withdrawals, you're looking at about £48,000 of income, with 189,000 left. 7% would be £83,000, almost £84,000 of income, with 131-ish thousand pounds left. I said that we also modelled this for the 60-40 portfolio. Now, in one sense, the results for this were even more surprising to me, because we've just lived through a period that's been pretty dismal for bonds, and it's the underperformance of bonds has really hurt a lot of people in their investments. But even with that mix of bonds in there as well, with 4% withdrawals, your £100,000 will have grown to £158,000. And with 7%, even with 7% withdrawals, even with a 60-40 portfolio where returns would have been hampered, let's say, by those bonds, you would have £110,000 left. So still more than you started with. Now, what viewers and listeners can't see is the charts that we've produced alongside this. And when you look at that 60-40 portfolio, it's a lot smoother, isn't it? It's not as high, the returns aren't as good, but it has actually done its job, the 60-40 portfolio, in sort of smoothing out returns.
It has smoothed out the returns, and that is very important, particularly from a psychological point of view. Yeah. When you're in this process of essentially running down your savings or taking an income from your pension pot. That's the point where temperamentally, psychologically, it's very difficult to handle big swings in the market.
Yeah.
So I think that the 60-40 portfolio does address that, does mitigate that to a large extent. I mean, you said that the returns were still high, and they are still, surprisingly high, but they are also significantly lower than the 100% equity investment portfolio. So I think that at 4%, I think the difference is between 188 and 158 or something like that.
That's right.
So, 30,000 pounds doesn't sound a huge amount, but we're talking about a starting pension of £100,000. For someone with a reasonably meaningful retirement pot, let's say £500,000, so 5 times that. Yeah. Then that 30,000 difference is actually £150,000 difference. That's a pretty significant amount. So I mean, you are paying a reasonably heavy price for that smoothing of returns.
Yeah. And it's very difficult to put a value on it, but you're right. You definitely see it, particularly on larger pots. I think we can conclude from all of that being able to fund your retirement in this way has paid off, hasn't it? For a lot of the people who were able to do that after 2015. We should say here that the whole point of that exercise in 2015 was to free people up from having to buy an annuity. Back then, a comparable sort of annuity income on £100,000 of savings would have been about £5,300. Okay, so 4,000 or 4% would be 4,000, 5% would be 5,000. Annuities were paying slightly more than that, but less than 6 and 7% clearly. But of course, you don't have the money left over at the end of it. I mean, that's the crucial thing. Those are headline figures, but this work was interesting for other reasons as well. That isn't the whole story. We were able to see through our numbers how far the value of pots fell along the way in that journey. And this is really noteworthy because in that first year, Tom, after April 2015, it was actually really horrible to be in markets in this position of beginning your decumulation from investments, because the one thing you don't want to happen is to have a big fall immediately once you start withdrawing money. That's when most of your pot is still exposed to markets. We've done lots of work about sequence of returns risk, and that's exactly what you don't want to happen. And that is what happened. It was a horrible first year, and even after something like 10 months, I think, after the beginning of pension freedoms, pots might have fallen by 20% if you were taking sort of the higher amounts. That would have been very, very alarming. Even at the lower amounts, it would have been very alarming.
So we did some work on this, what you call their sequencing risk,
Yeah.
and it's really, really important. It's totally relevant to this because actually it suggests that the figures that you've ended up with could actually have been a great deal better. So when we did this work on sequencing risks, we took two investors, both taking the same amount of income out, both having exactly the same calendar year returns for a decade, but flipped them over so that one of the investors had a good start and then a bad finish to that 10-year period, and the other had the exact reverse. So the difference was very significant. The investor who had the good start and then tailed off ended up with 25% more
Much better
in capital than the other one. So the example that you've given, the real life example of the last 10 years, is actually the second example of poor returns followed by better returns, and yet it still came out with very good result.
And this is the takeaway from the whole exercise for me. It's that that would have been horrible. Imagine if you retired, you've done all your planning and you've set your withdrawals at a very prudent level, and then 10 months later your pot is 20% lower. And you're staring at the next sort of 29 and a half years of retirement or whatever you think you're going to have left, and a fifth of your money is gone.
Well, you would seriously doubt that your money would last.
You would seriously doubt it. And yet, with hindsight, we know that not only has it lasted, it's gone on to grow and grow and grow, and you're left with basically more money than you actually need. You now have to we'll come on to what you do next, but you then, it's clear you weren't taking enough, but you didn't know it at the time.
No, absolutely. And I have to say that this is my major concern about this new world that we've created, this post final salary pension scheme world that we have created, is that this is what we do. We talk about money and we understand it, and we understand the need to take a long-term view, etc., etc., etc. For most people, they're not interested enough. They don't understand it, and frankly, as you say, it's terrifying. You've worked hard, you've saved all this money throughout your working life, and within a year it's worth 20% than when you started. People are going to behave in slightly suboptimal, irrational ways.
Well, the worst thing that could have happened, I suppose, is that someone's like, oh yeah, I can handle the ups and downs of drawdown and the markets. They do that, they see those losses, and they think, oh my god, I better take what I have now and now buy an annuity, which would have locked in a much lower income. And I dare say there probably were people that did do that, but it's a lesson in staying the course, but also it's a lesson in how hard that actually is, particularly in that phase of life, right, where we've spoken about it a lot. You're not earning money from a salary. You can't sort of plug gaps in your funds if you need to. This is it, and it's basically finite.
Totally. And the way that you view the world and your money when you're in your 60s is totally different from when you're in your 20s and 30s. And you are much more risk averse.
Yeah, and I'm going to interject here and say all of this clearly, obviously, is based on past performance, which is not going to be repeated in the future. And none of this is a basis for any kind of financial plan. I mean, we've spoken that, yes, in the last 10 years, you probably could have afforded to take much higher amounts than 4 or 5%, say. But it's very unlikely a sensible, prudent financial advisor is going to tell you to take more than that, because the maths have been on your side this time, but they might not be for the next 10 years. And even now with these, if you did have £189,000 in your pot, that might not last, because you might be, the next big crash might be around the corner. You still don't know. So that's an important thing to say. And these are very simplistic scenarios, but hopefully they should give people some reassurance about the power of markets over long periods to recover. And And, in our written article that accompanies this, we've spoken about some of the mitigations that people can put in place to kind of help them, because there are ways, aren't there, to reduce the risk that your income's going to dry up.
Yes, I mean, one very simple thing that you can do is to ensure that you have, a proportion of your pension pot in the form of ready cash, so that when you do get these ups and downs in the markets, which are inevitable, there will be falls in the market, you can draw money from your cash pool.
Yep.
And let's say you can do that for a year, and at the end of the year you can make a judgment about whether you want to pull some money from your investments and put it in and replenish the cash that you've spent from your cash pool, or not. So having that cash buffer gives you quite a degree of flexibility.
And in that scenario, you'd be looking for, had your investments done well or relatively well. If they've done well enough, you can kind of replenish. But if they haven't, you can leave them alone. You don't sell those assets when they're lower in price. You give them time to recover. You don't know that they will, but you can give them time. And actually, looking at the numbers here, what you don't want to happen is to have a fall in markets. You're going to have falls, but you don't want then to kind of prices to stay low for a long period and really test your your cash reserves and what have you, and make you sell assets to produce income. You want a cash pot ideally big enough to see out any kind of prolonged
you do,
dip
which
in
probably
markets.
means that you're probably looking at a cash pot worth 2 to 3 years worth of spending.
That's right.
Which will be a significant amount of money, and you might think, well,
you can't have that invested.
That's
in the
a lot of money.
That's
not being invested. Is probably not earning a huge amount of money, but it is the prudent thing to do.
And finally, it does say something about withdrawal levels, doesn't it? The 4% rule, we talk about it all the time. When you talk to financial advisors, some have heard of it, some base their sort of plans on something similar to 4%. But I think there's a growing consensus that it is very conservative. In fact, it is. I mean, if you look at the rationale behind it, it's supposed to be a level that protects your money in all but the most extremely negative scenarios, right? If 4% prepares you for the kind of big crash, basically, and if you don't experience that, you're probably going to end up, as in our examples, with a pot that's grown over the years rather than been depleted.
Yeah, almost certainly. And if you look at the long-term numbers on the stock market, so UBS work with some professors at the London, they used to be at the London Business School, who analysed the figures over the last 125 years, and they show that in the US and the UK, the returns from shares amount to close to 10% a year over that long run. Now, obviously, there are big variations along the way, but the difference between that 10% and the 4% is quite a wide buffer. It's quite a margin of safety.
Yeah, indeed. Okay, so let's point people to our website, fidelity.co.uk, where they can find the full article, which includes all these numbers, all the methodology, the rationale, and lots of other details as well. But that said, that is all the time we have for now, Tom. Thanks for joining me.
Thanks, Ed.